When it comes to debt, credit score, and credit report, there are so many myths and misconceptions out there about that, how you can build your credit score. But you may not like credit, but unfortunately, if you're looking to get anything as far as like getting a loan, you need to establish some sort of credit history. The way I see credit personally, I see it as a tool. A tool basically can be used for good or bad. It comes down to how you choose to use it. Hey guys, welcome back to the Perspective channel. If this is your first time here, my name is Claude. I'm a real estate agent and a mortgage broker here in Atlanta. I do this video every week where I share my perspective on a range of topics from real estate to personal finance and business. In today's video, I will go over 7 myths about credit score. The first myth is that checking your credit score will lower your score. That's false. You can actually check your credit score yourself. Because if you're trying to establish credit, or if you're looking to get your score to a certain level, so you need to have an understanding as far as like where you are and where you're trying to go. So therefore, you can actually check your credit. If you check your credit yourself, it is a soft pull. On the other hand, if you have a friend that's like a mortgage broker and you ask him to check your credit for you, that will definitely affect your credit score because that is a hard pull. Whenever you have a third party pull your credit for any kind of reason, that will definitely affect your credit score. But you as a person, you can check your credit score as many times as you want, and that will not affect your credit score. Myth number 2, carrying a balance will boost your credit score. That is false. Basically, having a balance does not help you at all because think about it. A credit card will charge you a high interest. So the higher the balance on your card is, the higher the interest you're gonna pay. At the same time, when you're looking as far as like your utilization rate, you don't want it to be too high. Say for instance, if you have a balance of $1,000 and you owe $900 on it, so you have a utilization rate of 90%. That's not good. The lower your balance is, the better it is for you. Also, because I'm into the real estate field and the mortgage field, if you're looking to get a mortgage, we're looking at your debt to income ratio. So the lower your balance is, the better that will help you as far as like when it comes to qualify for a mortgage. So no, if you're carrying a high balance on your card, it's not going to boost your credit score. So the plan is to have the low as possible, because not only will that not help your credit score, but you're going to pay a lot into interest. Because the bank, on the other hand, they want you to have a high balance, because the higher the balance is, the more interest you're paying every month on that card. It doesn't make any sense to carry a high balance. You want to bring it as low as you possibly can. Myth number 3, my income impacts my credit score. Once again, that is false. Your income has nothing to do with your credit score. Basically, what your income does, it shows your ability to repay whatever debt you have. Whether it's a mortgage, whether it's your regular bills, the higher your income show your creditor that you have an ability to repay your debt. Another way you can think of income as well, if you're looking to get a property, looking to get a mortgage, that plays a role into your debt to income ratio. So if you have a good income and you have a lower debt, that will definitely help you to stay behind the threshold, whichever loan you're applying for. So your income has no kind of impact on your credit score. But at the same time, if you want a better chance of qualify for a mortgage, it does not hurt to have a good income. Myth number 4, paying off your debt increase your credit score. This is a tricky one. It can be both true and false. This is true, say for instance, if you have a credit card and you pay it off, that will definitely boost your income. On the other hand, if you have like a mortgage or car loan, that's not going to help your credit score that much. So it can be, once again, depends on what kind of debt you have. It could be both true and false. But at the same time, you shouldn't want to carry any debt to begin with, because the higher debt you have, the more you're going to pay in interest. So the goal here, although you want to carry some debt, but at the same time, you don't want to carry a lot of debt where every month you're paying a lot of interest to your creditor. So you want to use credit wisely to build credit, but if you're in a position to pay it off every month, it is better because you can avoid paying interest. So the goal, once again, is not to carry a lot of debt. Use it wisely as a way to help you build your credit score. Myth number 5, student loan does not affect your credit score. That's a false. Any kind of debt that you have will have an impact on your credit score, especially student loan. When we talk about student loan, say for instance, if you're applying for FHA loan, we're gonna take your student loan, we're gonna take 1% of the balance and use that as your debt. So if you have a high student loan balance and 1% of that applied towards your debt, that could make a big difference as far as like when it comes to your debt to income ratio, because the big thing that we always look for is one, your ability to repay. So you want to have your debt to be as low as possible and your income to be as high as possible. If you carry like a large student loan debt and credit card and all this other debt, that will definitely affect your potential to get qualified for a higher amount. So you want to keep it as low as you possibly can, because when you go apply for a mortgage, that will determine what kind of mortgage you qualify for, at what interest rate, what is the amount that the lender will qualify you for. Myth number 6, getting married will merge my credit score with my spouse. That's false. When it comes to your credit report, that's individual. So your credit is your credit. But at the same time, once you get married, you guys file jointly as far as like getting a mortgage and getting things jointly. So that particular debt will be both on you and your spouse credit report. Say for instance, if you have a mortgage with your spouse jointly, one of you guys failed to pay the mortgage, that will reflect on both yours and your spouse credit report. So anything that you have jointly will show on each other's credit report. But at the same time, the report itself will be separate, but the bills that you have jointly will appear on each person's credit report. So whether it's good or bad, that will reflect on both of credit report. When it comes to apply for a mortgage, the lender will look at your score and your spouse score individually and look at each credit report individually. So we're not going to come by the credit report. So we're going to probably look at the score and come with an average score for both parties. So getting married, we're not going to merge a credit report, but at the same time, going to show whatever stuff that you guys have in common jointly showing up on each other's credit report. Myth 7, closing a credit card will improve my credit score. That is absolutely false. When you close a credit card, that basically reduces your available balance. Say for instance, if you have a card that's like $1,000, then you close it out. So that reduces your available credit by $1,000. That's not going to help you. That's actually going to hurt you, because that shows your utilization rate going to increase because you have less of available credit to you. It doesn't make any sense for you to close a credit card once you pay it off. Only time it makes sense is when you have a credit card that charges an annual fee, then it doesn't make any sense for you to have that card. So if that is the case, what you can do, you can reach out to the credit card company and ask them if they can give you a card that does not have any kind of annual fee attached to it. Because it doesn't make any sense for you to paying a fee for a card that you're not using. But if there's no fee attached to it, so it does not make sense for you to pay it off and close it. So you want to leave it open, even when it comes to your debt to income ratio. So it's going to show that you don't have a lot of debt, but you have all this available credit to you. So you just got to be smart. There's a lot of myths out there, so you got to think through it and don't believe everything that you hear. So once again, guys, if you find this video helpful, please don't forget to like, subscribe, and share. I want to thank you guys for watching, and I'll definitely see you on the next video.